Here's a metaphor. Imagine that the White House ballroom is already filling with balloons, and they're going to pop. Each balloon is a market, each one a price, swelling on cheap money and optimism. Stocks, real estate, bonds, crypto, even fine art, visible, buoyed by belief. Picture chandeliers in marble as unrealistic valuations float toward the ceiling. An everything bubble many investors whisper about. Stocks, real estate, bonds, art, and everything in between. The crowd cheers like it's a bull market forever. AI headlines, record S&P bidding wars, zero-day options, data confetti in the air. These shimmering balloons lift on policy and psychology. Low rates, QE, stimulus, narratives turning caution into euphoria. Then, a pin appears, almost unseen. It glides toward the first balloon. Quiet, inevitable. One pop echoes. Panic becomes a chain reaction. This is the everything bubble. One room, many assets, one air supply. Years of easy money push prices up together. Rising yields, inverted curves. Fear can turn to a stampede. Private markets, crypto, houses, bonds, commercial property, tied to the same air. They look safe. They look profitable. They seem inevitable. Yet, this levitation rests on fragile forces. Cheap money. Backstops. Liquidity waves. The belief that the party never ends. Then a shock. And another, then many. The chain begins. Tonight, the balloons hang high, expectations stretched. Confidence is thick, unspoken anxiety is thicker. So we ask the necessary question, are we inside an illusion so wide we cannot see its walls? And if we are, could our proudest breakthrough, artificial intelligence, be the pin? This is not fear, it is clarity about hope and risk. Hope, greed, the hush before the fall. QE to QT, calm to crisis, fast. What if this is the final quiet chapter? This isn't fear-mongering, just a search for clarity. Prepare for a sound that could echo through every market at once. Before we look ahead, we must look back. Patterns repeat with eerie regularity for those who forget. Remember, the pin is already in the room. First, a history lesson. History doesn't repeat, but it rhymes, and bubbles sing the same chorus. The ghosts of bubbles past, a primer in speculative mania. History doesn't repeat, it rhymes, and in finance, those rhymes often spell ruin. Each generation thinks it's different, that new tech or new markets defy gravity. Each time they're proven wrong. These aren't dusty anecdotes, they're blueprints for disaster. They show how investor psychology, easy money and leverage, and a compelling story combine into speculation and FOMO, ending in a painful hangover. The names and assets change, but the script stays the same. Consider tulip mania in 17th century Holland. Viral speculation gripped a booming merchant nation. Not over stocks or bonds, but over tulip bulbs. Rare bulbs fetched estate-level prices. Tradesmen quit to become dealers, leverage and FOMO, before social media. In winter 1637, the buying stopped. Prices collapsed. Devastation followed. A century later, the South Sea Bubble, 1720. A dazzling monopoly story sold the dream. Stocks soared on far-off promises, while cash flows were weak or fictional. Crowd psychology overpowered value. Even Newton lost a fortune. I can calculate heavenly motions, not the madness of people. The company imploded, trust and economy staggered. Fast forward to our lifetimes. .com 2000. Get big fast became doctrine. The internet was real. Profits often weren't. Internet company names rocketed on stories, not earnings, with sky-high price to sales and no cash flow. Saying, "It's different this time," drowned out caution. Then the Nasdaq cracked. The bubble burst. Trillions in market value vanished. Next, the housing bubble of the mid-2000s, driven by easy credit, complex derivatives, and moral hazard, homes only go up. In 2008, credit froze and defaults cascaded globally. These are the lessons we carry forward. For today's everything bubble, and AI, narratives can outrun fundamentals. Then gravity returns. Now, evidence of the everything bubble, the modern mirage. Evidence is hiding in plain sight. Major indices hover near highs while market breadth thins. Mega-cap tech drives the S&P 500 and the Nasdaq 100. The Schiller Cape and the Buffett indicator flag expensive territory versus long-term earnings and GDP. Look beneath the surface. Participation is narrowing as leadership concentrates. Parallel peaks with thinning breadth. Fewer stocks drive the gains. Indexes have hovered near records for years. Powered by mega-cap concentration. A handful of giants dominates returns. Late-cycle behavior funnels value into a few perceived winners. Faith narrows to a few can't-lose bets. That's when the structure turns fragile. Housing affordability plunges. Toronto, Sydney, Miami, Munich. Prices detach from local incomes. Affordability hits multi-decade lows. Home ownership turns speculative, enabled by ultra-low rates. Bonds, once the safe haven, entered their own bubble. Years of near-zero yields pushed investors out the risk curve, out of the safe shallows, into shark-infested waters of riskier assets. The search for yield inflated alternatives. Fine art, classic cars, luxury watches, rare whiskeys, and private markets. Private markets and venture capital post-unicorn valuations without profits, late-cycle behavior, startups with no earnings, unproven models, billion-dollar badges. All these bubbles interconnect, inflated by the same cheap air. They assume money stays cheap and that there's always another buyer. That interconnectedness is what makes the everything bubble dangerous. Unlike the dot-com bust or the housing crisis, a burst here could trigger a domino effect. A shock in one corner can cascade through the system, as losses force sales of safe assets to cover debts. The risk is systemic. Section 4, the central bank's fuel, how cheap money inflated the world. After 2008, central banks launched a vast experiment, ZIRP, negative rates, and QE. The engine of the everything bubble has been global central banks. Emergency policies became the norm after the financial crisis. U.S. Federal Reserve, the lead actor. European Central Bank, the aggressive follower. Bank of Japan, pioneer of ultra-easy money. Quantitative easing, mass bond buying, began. Policy rates were pushed to near zero. Chanstai. Chape. Also known as zero interest rate policy. In Europe and Japan, some even went negative. Goal 1, encourage borrowing for homes, cars, and projects. Goal 2, push spending and risk-taking higher. Cheap money lifted asset prices as QE flooded markets, but it discouraged saving and rewarded leverage. Near-zero borrowing costs rewired behavior across markets. Deposits earned almost nothing. Saving was discouraged. Corporations loaded up on cheap debt. Households and investors reached for yield in riskier assets. Companies borrowed trillions in bond markets, not always to build factories or create jobs, not always to fund research and innovation. Often, to finance buybacks, and that's never a sign of good things to come. Buybacks mechanically boosted EPS and prices, and with them, executive bonuses tied to stock performance. Governments borrowed more, comforted by low servicing costs. When QT and higher rates arrive, the same air that lifted prices can rush out. Into this room of rising balloons, a new story takes center stage. Artificial intelligence. AI is real and powerful. Generative models already reshape how we write, code, sell, and support. Chip makers, cloud platforms, and AI infrastructure providers rally on expectations of exponential demand. But valuation multiples price in flawless execution, mass adoption, widening margins, and durable moats. Productivity only becomes profit if compute costs, latency, and accuracy justify the spend. When narrative outruns unit economics, hype cycle peaks appear. The risk isn't the technology, it's the timeline and profitability. Tiny teams reach unicorn status with minimal revenue and steep burn. Crowded trades form fast. Retail piles in through thematic ETFs, amplifying the same few bets. If delivery lags, accuracy slips, costs stay high, or adoption slows, confidence can puncture fast. One high-profile miss, failed launch, or regulatory shock can flip the mood in a day. With hope and capital concentrated in AI, selling there can force de-risking across chips, cloud, and software. That is the hidden danger beneath the shimmer, the timeline and profits behind the promise. In times of widespread exuberance, it is easy to dismiss the voices of caution as relics of a bygone era, yet the wisdom of seasoned investors and economists forged in past market cycles offers a reality check in behavioral finance and bubble psychology. Their warnings aren't date-stamped crash calls, but observations on risk and human nature. Warren Buffett, the Oracle of Omaha, value investing reminds us, price is what you pay, value is what you get. A reminder, soaring price, AI stock or tulip bulb, can detach from intrinsic worth. Robert J. Shiller, Nobel laureate, warned before the dot-com bubble. He warned before the housing bubble. Behavioral finance shows stories move markets, Narrative economics explains why hype spreads faster than cash flow. Compelling narratives, like AI, can justify absurd valuations. Markets are driven by stories and emotions as much as by fundamentals. When the story is world-changing, like AI, collective delusion is magnified, leaving markets vulnerable to violent correction when that story falters. Other financial titans are blunt. Jeremy Grantham calls this a super bubble. 1. Michael Burry flags speculative froth in pointed, cryptic notes. These are not mere pessimism. They are calculated assessments from history's witnesses. They see patterns repeating: excessive leverage, feverish speculation in unproven tech, a widespread belief that this time is different. While media and Wall Street cheer, these voices urge caution. They remind us trees don't grow to the sky, and financial gravity, though suspended, is never repealed. Not predictions, frameworks for risk management in an everything bubble. Amid the market noise, a few dashboard lights actually matter, signals that help gauge systemic risk. Start with forward PE, what investors pay for next year's earnings. When multiples stretch, fragility rises. Then the Shiller Cape, a cyclically adjusted PE that smooths booms and busts. When Cape sits near historic extremes, expected long-run returns tend to fall. Market breadth matters. Are many stocks rising, or just a few mega-caps leading? Margin debt spikes signal speculation. Money borrowed to buy more stocks. Sudden drops in margin debt can force selling and cascade losses. Credit spreads, especially high yield versus treasuries, price in fear or complacency. Narrow spreads signal easy risk-taking. Sharp widening often marks the turn. Watch the yield curve, especially 2s 10s. Persistent inversion has preceded many recessions. IPO and SPAC waves reveal risk appetite. Issuance surges scream speculation. Thematic ETF inflows. AI, robotics, crypto. Big, fast money into narrow themes is classic herding. Housing affordability indexes track stress from prices, incomes, and mortgage rates. When they plunge, demand cracks. It's not about dates, it's about it's about rising odds. Keep this dashboard in view and really watch it. If AI disappointments prick the everything bubble, outcomes span a spectrum. Soft landing, valuation reset, slower growth, contained credit stress. Hard landing, risk-off selling, funding costs rise, liquidity tightens, systemic shock, contagion, counterparty fears, forced deleveraging across funds and banks. Preparation starts by knowing where your exposure sits in the credit cycle. 3 paths lie ahead: a soft landing, a major correction, or a systemic crisis. Best case, a soft landing. Broad markets pull back roughly 10 to 20%, speculative AI names a bit more, unemployment stays steady, diversification cushions the fall. Venture funding cools, IPOs narrow, and banks modestly tighten standards. Recession odds stay low, around 20 to 30%. A brief flight to quality favors treasuries and cash. Diversified portfolios absorb most of the shock. Central banks steady nerves, volatility fades, and growth resumes from a cleaner base. Tougher case, a major correction, sharper, broader, and more disruptive. High beta tech falls 30 to 50%. Venture funding slows. Banks tighten lending standards. Recession odds rise. Hiring freezes take hold. Correlations rise. Diversification helps less in the storm. A stronger flight to quality moves into cash and treasuries as households and firms retrench. Worst case, a systemic crisis. Defaults cascade. Liquidity freezes. Leveraged strategies unwind. Flight to quality dominates. Across paths, risk management beats prediction. We're back in the White House ballroom, balloons still drifting, the pins still poised. The balloons of the everything bubble, stocks, real estate, bonds, and the shimmering, iridescent balloon of AI. You can't control the pop, but you can choose your stance. Clarify your asset allocation, diversify broadly, and favor durable cash flow over headlines. It has become the focal point of market hope, and a likely source of great disappointment. Keep an emergency fund, rebalance with discipline. Avoid leverage you don't understand. Look with open eyes and acknowledge risk where it exists. Panic is useless. Preparation is wisdom. Use dollar-cost averaging to reduce timing risk. Watch valuation. Price matters. The timing is a mystery, but the outcome is not. When belief breaks, the rush for the exits is violent. The pain spreads from Wall Street to Main Street. Jobs, retirements, the economic security of millions. The choice is not whether to believe in a crash, but how to behave before that moment. Principles for action. This is not financial advice. Set an asset allocation aligned to your goals and risk. Diversify across asset classes, sectors, and geographies. Keep an emergency fund to navigate liquidity shocks. Favor real value, quality cash flows and sturdy balance sheets, profits that are recurring, cash flow that covers obligations, and business models that endure over exciting stories. Practice valuation discipline. Price matters. Rebalance on a schedule, not on headlines. Use dollar cost averaging. Guard against behavioral biases. FOMO, overconfidence, loss aversion. Remember the quiet room. The crowd still cheers as the balloons rise, but you've seen the pin. You understand the fragility of the moment. You can't stop the pop, but you can choose where to stand when it happens. Choose to be informed, to be prudent, and to be prepared. The future is unwritten, but the patterns of the past are clear. Listen to them, look at the data, ask the hard questions. Skepticism is a shield, preparation is a strategy. When the music changes, you'll be ready.